Hello, everyone. So quick introduction of our activities in Belgium. So the program was launched 2.5 years ago. Well, I started, in fact, 2.5 years ago, and I launched the program, and the website and all the figures you can see exist 1.5 year. But we have a little money to invest in radio programs. So I have a background as a marketeer. I think they hired me because there's a big, you have those awareness programs running. That's why we have a little money. And when I arrived, so first of all, I'm working for the FSMA, which is a financial authority. I won't go in details here. So in 2011, we had in the law a mission about financial education, and I arrived on board at the beginning of 2012. So the first word I heard when I met my boss was quick wins, quick wins. So this is why it was decided, we wouldn't do a big measurement. We would straight go make a website, launch initiatives, but without doing a big measurement of the situation of financial literacy in Belgium. As a marketeer, I was a little upset. We had big discussions, but in the end, I think we make of it an opportunity, and that's why I'll explain it to you. So we used a lot of the OECD research. I met colleagues from other countries, and we developed our program and our strategy based on international comparisons and common sense. We did a few focus groups, so we double-checked with a little bit of focus groups, but that's mainly what we did. So we have 3 pillars which were defined in 2012 in our program. General public with a web portal, interactive tools, and a first awareness raising campaign about pensions, which was a hot topic because there was a political reform. We decided, of course, as all the best practices do, that it's important to educate young people. So we started running the marathon to get financial education in the schools. Different systems in French-speaking Belgium and Flemish-speaking Belgium. So it's a very different approach, where in Flanders we go in the professional educational sector, whereas in Wallonia we go to the general educational sector with very different ways to do it. And the third thing was to create an environment for intermediaries, for actors on the field, and to try to play a role to promote financial education. So those were the 3 pillars. And this is the kind of, so we launched beginning of 2013, and this is the kind of interactive campaign we do. We use a lot of online. We use radio because the media is less expensive than TV, etc. And each time we try to promote, and I think this is why it works quite well, we try to develop interactive tools, quizzes, a game, here a special simulator or whatever, and we launch it with strong PR. As we are neutral and unbiased, we get a lot of media coverage, free media coverage. And then we enhance the campaign with some radio and bannering. And it works quite well. So we also assess, every time we assess our program, we try to make so many possible partnerships as possible, so that the message is just enhanced by all actors, as much as possible actors. So, so what I did, as we didn't have the global research, from day one, we followed the efficiency of our actions, like here, website. We have 1.3 million, we have 900,000 visitors and 1.3 million visits, which is, well, in 1 year and a half, good year and a half. One of the important KPIs, so we follow a lot of dashboards with Google Analytics, so organic traffic, which is important for us. It's people who try to find via Google or a research motor and who find our website. It's 44% and increased in 1 year, so 1 year and a half. No, in 1 year, sorry. And then we follow as a KPI some specific KPIs like how many times our simulator are used, our quizzes. Real estate simulator was the last one, 73,000, but it was only launched 3 months ago, so it's not bad. And so these are things we follow. Other KPIs, the paid traffic, because we have a small advertising budget for Google ads. The paid cost, how much you pay to be for those advertisements. The direct traffic, the referred traffic on the website, because the website is obviously our main tool. Of course, when we go, we have also other kind of marketing events, like newsletters. So we have 10,000 abonnees. I don't know, people who take subscribers. Yeah. We follow obviously the opening rate, the click rate, what works best, why it works best, where do the people go. Also for social media, we just started a few months ago, so it's very low. It's only 1,000 likes, but we noticed that the more funny it is and the less serious it is, the better it works. So we try really to make it funny. We use a lot of infographics, like you see, to get the message across very quickly. The bannering campaigns. All these are really classic marketing tools that we use to measure the efficiency of our campaigns. Now we are improving those measures day by day. Like now we are making a big exercise now to make the difference between just awareness, appreciation, action, and advocacy. How are the people who come on our website, who read our newsletters, who click on our banners, how are they reacting? So we are defining objectives, and then we classify earned, owned, and paid media, and we define objectives depending from the kind of media we are in. And then we are doing now this KPI exercise depending on what kind of objective we have. Is it only awareness, appreciation, action, or advocacy? And which are the classic KPIs we are following and which are the KPIs on social media we are following. So this is the kind of measurements you can improve in terms of marketing. But now comes 2 years after launch. We will have in January 2015 the opportunity to make a bigger measurement of the situation of financial education. But there are many measurements that already exist, specifically quantitative measures. So we really want to focus it on behavior and all the best practices we heard here today, opportunity, etc. But what we decided to do is to make it to use the measurement as a tool to create a broad public base and develop cooperation with key stakeholders and actors on the field. So in fact, in the month of November, we will invite, we send a letter to almost 80 stakeholders in Belgium, actors on the field, public but private, NGOs, etc. And we want to get them, want to interact with them. We know them, but now we want really to involve them in the exercise. So we, in the month of November, we'll have many table ronde groups working together just to see what should we measure, because those stakeholders have very often a much better knowledge of their stakeholders, of their public, and it's important to integrate their knowledge in the measurement. So we will use the framework of the OECD, but we will make it Belgian, and we make it by integrating their input. So We hope that this will be an opportunity together with those stakeholders to develop possible actions, and so to create a broader base to, well, to promote financial education in Belgium. So I think we couldn't have done this 2 years ago because we were in a phase of discovering. First of all, you don't know well enough what exactly financial education is. We have been working very, very hard to define the objectives. This is also something we want during those focus groups to check and double check with our stakeholders. Are the objectives that we think should be linked to financial education, are those also the objectives that you believe are important? So this is also the exercise we want to do. We know our stakeholders better, we know the program better, we have a better knowledge, and we also know how consumers react, and a little better anyway. We don't know a lot, but we know more than 2 years ago. So I think doing research later can be an opportunity because you get a better understanding of the program. You can also better identify target groups, I think. You better understand the active forces on the field, and you can use it as a collaboration project, and hopefully to set priorities and refine the refine the objectives. So the difficulty is, of course, that we started without really having long-term objectives, but I think also that as a marketeer, I can say that you start basically at the beginning with a kind of, even if we don't have a lot of means, with kind of a mass marketing. You address everyone, and it's only when you have a certain maturity in your program that you start addressing specific target groups. So I think that not having measured by the beginning, it is not such a big mistake. Perhaps Adele, you won't agree, because I think when you do this mass marketing with the means we have, we just wanted to create a certain awareness and to get a better understanding of what makes people move. And now we will be able to focus on specific groups. And I think by doing a more refined measurement of it, we will also be able to track more things that move. Whereas with the little means we have, when you spread it, when you dilute it in a mass, you dilute more your means when you do mass marketing. But nevertheless, I think when you start such a program, you start with a broad base, and then you go by, well, you refine your targets and your publics. So that's it.
My name's Cate Fisher. I work for the Money Advice Service in the UK, and I work in a research and evaluation capacity. So I'm just here to tell you about the work that we're currently doing to help support really and capacity build the financial capability sector to do more robust and meaningful evaluation to really help us understand further, what works in improving people's financial capability. So I think it's just worth pointing out that in the UK at the moment we talk very much about financial capability rather than financial literacy. I'll come on to just how we're starting to define that in a couple of slides, but I think it's slightly wider than financial literacy. So it encompasses those internal elements of someone's knowledge, skills, attitudes and mindset around financial issues, but it also covers those external elements, the sort of social norms, positive and negative influences in wider society that are affecting someone's behaviour, as well as access to and ease of use of financial services and products. So just very quickly for a bit of context, who are the Money Advice Service for those of you who don't know us? We were set up in 2010 by the government, and we have a statutory duty to increase the financial capability of the UK population and to help people budget better, manage their money better, and increase their general financial resilience and well-being. So we're overseen by the Financial Conduct Authority, who are the financial services regulator in the UK, and we work very closely with them. We provide free, impartial money and debt advice, and we do that directly through our website, as well as through partners delivering face-to-face and telephone advice. And we reach about 16 million people per year. And we do quite a lot of evaluation of our own services, including trying to understand the impact of our web content, including information and practical tools. But we're also, we have what we call a thought leadership role in terms of our relationship with the rest of the financial capability sector. And one of the ways in which that manifests itself is that we're leading on the development of the new financial capability strategy for the UK. And this is something that we are doing collaboratively and really co-producing with a number of other partners from across the regulatory bodies, public sector, private sector, financial services industry, and we're delivering together as a whole sector. So in this capacity, we sent out a call for evidence last year and said, look, we've been charged with or tasked with developing this strategy. What do we need to know? What evidence do we need to consider? What role do you want us to take in this? And one of the key pieces of feedback we got is that there are pockets of really excellent evaluation practice in the UK, some great examples of really robust comprehensive studies about what works and what doesn't work in improving people's financial capability. But there's still a lack of consistency in the way people approach that evaluation. There is also a lack of guidance that's tailored for the UK context about really how to evaluate. And we can see from the kind of measures that people are using to assess impact of their services, a lot of times they focus more on outputs rather than outcomes, things like customer satisfaction, awareness of the services, engagement, reach, things that are very important to monitor, but in and of themselves don't tell us about what impact or what additionality that programme is actually having. So a core part of our strategy is to develop an evaluation toolkit, which will help provide guidance, advice, practical tools to funders, commissioners, practitioners on how to actually conduct impact evaluation, which is obviously, it's a challenging task. Impact evaluation is not an easy thing necessarily to do. It's not easy for experts in research and evaluation, let alone frontline practitioners and people who haven't had sort of training and experience in this area. So I think we're quite realistic about what we can achieve, but what we're doing is we're producing an outcomes framework, which we have a draft version of, and I can show you in the next slide, which will provide greater guidance on exactly what to measure, what we think is important in terms of the outcomes that organisations should be looking for. And I think that's key because as Greg was talking earlier, in the UK we don't have an agreed definition currently of financial capability versus financial well-being and financial behaviour. And one thing that we're really trying to achieve with this outcomes framework is to develop a common language and a common understanding about what we mean by these different terms and what kind of indicators could be used to measure a client's progress in these areas. So it's worth saying that this toolkit is aimed at organisations, frontline organisations who work directly with beneficiaries to try and improve their financial behaviour and financial situation. So ultimately, the goal of this, we don't, as none of us advocate evaluation for its own sake, what we want to do is improve the evidence base and really help to give practitioners, providers, commissioners the evidence that they need to make good decisions about what kind of programmes to fund and deliver. And it's all about making the best use of resources, because we have fairly limited resources in the sector, so we don't want them to go to things that aren't ultimately working, obviously. So in addition to this outcomes framework, which I'll show you in a minute, we're also developing step-by-step guidance and a suite of practical tools which should help organisations to conduct probably fairly basic impact evaluation. We'll be aiming to encourage them to baseline at the start of an intervention and measure distance travelled in their client group. It may involve a control group if an intervention is being delivered in a school and there's a natural sort of control group of another class. That's great, but we know in a lot of situations it's very hard to actually find that counterfactual. But we recognise that evaluation has to be proportionate and appropriate. We're not going out and saying every single programme needs to be evaluated. We need to be fairly targeted and identify what the key evidence gaps are, and also let organisations make their own decisions about what's proportionate and appropriate for them compared to the kind of resource they have for delivering the actual programme and the kind of learning that they think they need to get out of it. But we wanted to try and create something that was fairly flexible and adaptable. It's never going to be a one-size-fits-all, the sort of magic evaluation bullet. But the feedback that we got was the more flexible you can make it, the more it will be, a useful tool for a greater number of organisations. So, as I say, I know various people on this panel have extolled the virtues and the importance of evaluation and of research. I mean, what we're trying to do is really improve the evidence base, as I said, also help organisations to continuously improve the services that they're delivering, and also possibly going forward try and create some benchmarks as to what level of impact or change it's feasible to think that interventions of certain types can achieve, and that then gives other providers a useful benchmark against which to compare the efficacy and the impact that their own services are achieving. So I'll just go on to quickly show you our outcomes framework. It's fairly small writing on the actual framework, and I don't have much time to talk it through in depth. If anyone's interested in it, do come up to me afterwards. I'll be around for a while and I can talk it through in more detail. But what we've done is we've tried to distinguish, or we have differentiated between financial capability and financial behaviour. Now, Adele was talking about this earlier. We wanted to recognise that someone's skills and knowledge and also access to financial services and products and attitudes and mindset are very, very important. But ultimately, as I'm sure we all know, if they don't have the financial means to, say, start saving or to start saving in a pension, possibly, they won't actually be able to exhibit those behaviours that their capability might otherwise enable them to do. So if I stand up briefly, shout if you can't hear me. But here we have financial capability. So we've got ability, skills and knowledge. Mindset, which is very much about attitudes and motivations, things like self-confidence, attitudes to the future, aspirations and goals. Can you not hear me on the video? Do you want? Right, I'll come back. And then connection and positive and negative influences are about, as I say, those external elements of financial capability. The social norms that someone operates within. We know in the UK it's having credit, taking out credit to afford sort of basic things is fairly normalised, and we know that's a problem. Also accessibility of high cost credit, for example, is a problem, but for a lot of people they are still excluded from being able to access the kind of financial advice or information that would help them to make better decisions with their money. So ideally, if someone has the necessary financial capability and their means allows, they can exhibit financially capable behaviours in a number of areas. And ultimately, the goal is that will then increase their financial well-being. So this is the basis of the outcomes framework that we've developed. It involves a mixture of hard and soft outcomes, so the soft outcomes being those attitudinal changes, changes in self-reported or tested knowledge and understanding, and those hard outcomes being those actual behavioural changes. Someone started saving, or they've started budgeting and sticking to it, or started reducing their problem debt if they have it. And we have a full report. I haven't brought it up, but it's fairly hefty, as Adele knows. And we have developed indicators underlying each of these areas, and what we'll be looking to do is develop measurement tools, or rather find measurement tools that already exist that can be used to measure progress against each of these indicators. And just one thing to say is that we're not expecting organisations will measure progress in all of these areas. It's very much, as I said before, we wanted to create something flexible, and it's for organisations or funders to sit down and work out what the key outcomes that they're really trying to achieve are, and then work backwards to think about what they need to measure. But, we are advocating, or we will be providing, it's mainly survey questions to actually measure these things. Although, as others have said, if we can get actual, administrative data showing whether the behaviour change has happened, that is ideal and that's better. But it's not available in a lot of circumstances. So it's worth saying as well, we've also developed, this is the adults framework, we've also developed one for children and young people. And it has a number of different sets of indicators which are relevant for children from the age of 3 up to 18. And we've set the initial age at 3, the lower end of the spectrum, because our research has shown that actually, in terms of financial sort of habits and very broad attitudes, a lot of children's habits and attitudes are actually more or less set by the age of 7, which is a fairly scary thought for any parents in the room. And actually those things like self-control and confidence confidence to challenge, those things are attitudes and behaviours that are instilled quite early on. So we wanted to help to encourage and promote interventions that work with children and parents at the lower end of the age spectrum. So, as Sophie said, this is very much still in development. We've actually just finished a consultation on this, as well as on the rest of the draft strategy, which is available on our website, although I've got some copies that I can give out to anyone who's interested afterwards. So we're very much still in the process of refining it, of adapting it, and we'll be piloting it next year. And it won't be until the end of next year, end of 2015, that we actually sort of unveil it properly and make it publicly available. So I just very quickly thought I'd just run through some of the key challenges that we face, and I'm sure other countries are facing, around research and evaluation, although if anyone has any solutions, please do let us know. One is that one we've touched on already, self-reported versus objective measures of behaviour change. Now, we know people like Public Health England, who we work quite closely with on some things, actually don't use any self-reported measures of behaviour change anymore because they've just found them to be too unreliable. They use things like pedometers to measure, the amount of activity someone's doing, or monitor someone's spending habits to look at what food they're buying. Where we have that data, that's brilliant because we strongly suspect that self-reported behaviour in the financial capability sphere or financial sphere is probably quite similar to that in the health behaviour sphere. Resourcing is an issue, both convincing funders and commissioners to ring-fence a proportion of their funding for research and evaluation if it's appropriate is, a difficult ask sometimes when they want to say that they want to maximise the number of people that they've, reached. Equally, practitioners on the front line say we just want to get on with our job of helping people. We don't really see how this, survey or whatever else it is helping us to do that. So convincing and really getting the buy-in of key decision makers as well as practitioners on the ground is a really important challenge that we're facing. This question of short or long-term behaviour change, it's very hard to measure longer-term behaviour change. It's resource intensive. Once you go beyond a year after an intervention, attribution is very difficult to be certain of. And actually, maybe it's this holy grail that is a bit of a red herring. Maybe none of us can create longer-term behaviour change, and it is about intervening at certain key points, life events, teachable moments, and creating the circumstance in which someone can have a better behaviour just within that specific point. And the last one is transparency about what doesn't work as well as what does. So we heard about the meta-analysis this morning of financial education in schools, suggesting that actually after 18 months it has very minimal impact in predicting young people's financial decisions. So it's great to have that. A lot of organisations, wouldn't necessarily put that information in the public domain if they had the choice, because understandably there is a positive publication bias. People want to show that what they're doing is working in terms of their reputation and in terms of sustaining their funding, and that's completely understandable. But unless we know what doesn't work as well as what does, we're not going to be able to make efficient or effective progress in this area. So that's it from me, really.
It's a question for all panelists. It's when you try to raise awareness with your campaigns, of course, so you measure awareness, but what kind of tools we can use to measure actual, changes in behavior, except the long-term surveys after some awareness campaigns, because it's not just about awareness. It's actually about something that can be changed at home, on personal finances. You know, is there some kind of easy tools to measure that, and quick? I know it's a very difficult question.
Part of what we're trying to do with the Ask and Check campaign is to have people check out the background of their financial professional, to making sure that they're licensed. The other part is checking the background of the product, to make sure it's registered with the SEC. The 2009 Financial Capability Survey actually asked people the question, have you checked out the background of your financial professional? That number was extraordinarily low. So, you know, using that data, we may have a cause and effect issue. You know, that may be sort of a challenge, but what we would like to see is that number go up, that people are checking the background of their financial professional and of the companies. It's easier for us to check the financial professional than it is for the registered products, but that's sort of one of the marks for us. One other thing with an anti-fraud campaign, it's very difficult to measure success in that, because what's the success? You're not taken by a fraud. So how do you measure that? And it's difficult, if not impossible, to measure.
Work as on anti-fraud to all those people who are not losing money to it. And you can measure that by seeing where the money goes to. So if you have an inflow in saving accounts instead of investment accounts, or an outflow from saving accounts into something else, then you can measure that. So the higher the volatility of the money, the more opportunities people see where the money goes to. So that's a difficult thing to do, but there is somebody, the central bank or maybe the SEC, who can watch those kinds of movements. And the other thing was just a question that pops up, because I know the settlement fund at the SEC is very, very big, of not collected settlement funds. Can you use just 1% of that fund for financial education, or is it earmarked for just getting back the budget?
It very much depends on the size of your intervention, but if your intervention is on a national scale, then you can look at national data to see whether that behaviour has resulted in more savings or higher take-up of pensions or whatever it is you were trying to achieve. If it's a small program, then, as I was saying before, you can maybe ask people to provide bank account details. It really depends on the level of trust and the expectations that people have when they participate and what kind of a program you're looking at. But there are other ways that you can capture behaviour as well. You can create questions that try to avoid making it very obvious what behaviour you're capturing. So you could have, say, a list of 20 behaviours so that it's not obvious to the person when they answer the question that you're really interested in one or two of those. So then you can see if they're the kind of person that just says, yes, of course, I've improved or I've done something. And you can use words that don't make it clear to them which is the correct answer and which is not the correct answer. So there are ways in which you develop questions that help you to unpick whatever it is you're interested in. We've put a couple of questions in our latest questionnaire, so do have a look at that as well, because that's trying to unpick those things. But you could also, you can ask participants, if it's a longer term program, to keep a diary, but you have to be careful with that because it tends to change behaviour itself. So it's nice, and if actually the only thing you're interested in is a positive outcome, then it's probably going to help you achieve a positive outcome. But if it's a genuine proof that the program itself works, it probably would work less well without the diaries. So kind of swings and roundabouts with that one. But it's really a case of being imaginative and thinking about how you could possibly find some data that will prove that there's really been a change. And sometimes qualitative work, sometimes interviewing people, because people sit and talk and eventually they lose their inhibitions and they're not quite sure what the purpose of the conversation is, and they will tell you, well, yeah, you know, I put money in my savings account, but it only lasted 3 days because then I had to pay the telephone bill, so I moved it back out again. So you can say to yourself, okay, so in a survey questionnaire, they probably say they put more money in savings, but you probably haven't really achieved anything because it was just a very short-term switch with their bank account. So qualitative data shouldn't be overlooked.
I mean, just to echo, we know measuring behaviour reliably with survey questions is hard. It's not impossible, but there will always be, you know, inherent biases or issues with data quality there. I think, yeah, where you can access admin data, there have been various evaluations in the UK, so one involving social housing participants, and that, in addition to self-reports of, you know, improved confidence and understanding of financial issues, also used rent arrears data to actually look to see if people were, you know, managing their money better and not getting behind with their bills. Equally, if you have access to admin data, or we were having conversations with someone the other day about accessing club cards, sort of loyalty card schemes, to see if, you know, after an intervention people did shop around more within that one shop, or move to cheaper sort of quality, well, not cheaper quality goods, but, you know, cheaper goods. So there are potential options. I mean, I think one thing that we struggle with at the national level is attribution, really. So, you know, often there are so many things going on, say, saving, you know, regulatory changes, as well as public behaviour campaigns and things like that. So it's quite hard often to disentangle what the impact of your particular programme is if you're looking at data at a national level. But I suppose that's the importance of triangulating your data as well, using qualitative, using some quant or admin data if you have it, and looking at the national picture as a comparator as well.
No, we just use the post-tests of campaign, and we introduce a few questions like, was it useful, but it's more like self-measurement, or how do you call it, self-reported measures, or do you plan to do something? But more than that, up to now, we didn't. But you can have your KPIs, and then you can also have a bigger dashboard with your stats. But these are long-term trends which are difficult to make them move. So don't have. I think it's very ambitious if you want to make those. If you want to see after a few campaigns a difference in the long-term trends, it's your campaigns were really very effective.
It's much more easier to administrate. You've got online tools. It's very cheap and quick and easy to do surveys, actually. But as you said, Thomas, surveys do actually not capture behavior, and actual behavior measurement is much more costly and resource intensive. It's harder to plan, and so I assume that funding is one of the major issues for that, actually, in the end. So my question to you all would be, how do you convince potential funders that measuring outcomes is more valuable, and they should spend the extra money on that instead of on a survey, for example?
Funding is a challenge. If we don't have enough money to do examination programs of investment advisors, between that or doing an investor education campaign, we're probably going to spend the money on doing exams. So we balance examinations, enforcement, and education. We do an awful lot with a very small budget. My program budget's around $1 million a year. Just our overall request for funding for Congress for this fiscal year is $1.9 billion, if that gives you an idea. That's why we leverage partnerships an awful lot.
One of the important things is that you actually have to work with your stakeholders. I think it's really important that you have a positive relationship with your stakeholders before you start, and that's everybody from the end users through to the program designers. And if you believe evaluation is an important part of what you're trying to achieve, then you have to have this discussion with your stakeholders and make them realize why it's important and why it should be part of your budget. And you shouldn't separate your program budget from your evaluation budget. If you've already decided an evaluation is necessary, then you should see it as one budget that has separate components, because at the end of the day, you want to be able to say, this program is actually worth continuing. Otherwise, you're wasting money, you're wasting people's time. You're taking real people who hope to improve their financial literacy, and you're giving them nothing. And that really should not be happening. So evaluation is essential, and I think it's just a case of sitting down and getting everybody in the room to see why.
One thing I tried to do when I arrived, it was just a story about the quick wins. So I think if you can provide a few milestones and quick wins, perhaps not on behavior, but on something else, to the people who fund the program, they might already be happy. So because they have to show that there are results in a short term, it's part of everything, part of the program. So I think you have perhaps to make a dissociation between more short terms, milestones, things you can achieve, that you can show that there is progress, and on the other hand, investing long term. And by using those two kind of tools and metrics, I think you can sell a mix of something.
Can I just add quickly? Just to say, it's not an easy task. I think I would agree with Adele. It's all about communication. It's about really trying to get buy-in at every level. So one thing that we want to do over the next few years is develop a network of evaluation champions, and they might come from practitioner organisations, providers, funders. We want to really embed this appreciation of the understanding of the importance of using evidence to make decisions and of evaluation, rather than it being seen as something that the Money Advice Service comes in and does and takes the findings away from. So it's about trying to get people to engage with the evidence. How we go about doing it is difficult. I think it's about talking the language of whoever you're engaging with. So with frontline practitioners, that might be about, emphasising that evaluation actually helps them make the biggest difference to the lives of the people they're working with. For local authorities, it might be that, but also talking about accountability of funds and the need to prove that they're using public money in the most effective way and making the best use of resources. So I think it's about tailoring those messages as to why evaluation is important to the different partners that you're working with.
Short. Could you consider the number and value of complaints to national authorities or compensation scheme could be a variable for valuation on the long term?
Why you would assume that complaints would go down?
The complaints from the public to national competent authorities, or a compensation scheme for products mis-selling or something like this, for example.
Okay. My feeling is that if you're providing financial education, there's a very real chance that complaints will go up, but not necessarily because mis-selling is increasing, but because people are more aware of what's going on. So if you wanted to use it as a target, you'd have to have a very clear model of what you expected, because I honestly couldn't tell you which way that would move. I think it would be very, very hard to make an assumption. That would be interesting data. And actually people do use complaints data, particularly when they're creating a national strategy, to say, look, we clearly have issues here, and they're not issues that we haven't tried to tackle with regulation. There's some other issue that consumers are misunderstanding. But to assume that complaints are going to go down after financial education, I think is quite risky. But I'm only making an assumption, I don't know.
So I would agree with Adele's point. Over time, you might hope that people ended up accessing products that better meet their needs and mis-selling goes down. But I think certainly in the shorter term, we think, I'm with Adele, it would be difficult to use as a measure, although isn't it of success, although it's definitely an important thing to monitor.
Is there any country in the EU or in the world where customers are paying for information or investors' education or customer education? I don't know any, but maybe you know, because normally the customers are paying a lot of money because of bad products and so on. But is there any country where the customer are willing to pay for informations in times of internet?
I can cite a German example, the Stiftung Warentest, which is a foundation that tests products, financial products as well, actually, and then publishes the results of those tests. And it doesn't cost much to access the results, but people are paying for that, I believe.
Indirectly, yeah, sure, the companies, but the customer as well.
As a private person, if you want to access the results, I think.
Okay, you have to you have to buy the magazine. That's true. Yeah. Okay.
So they are presumably at least covering their own wages, if not making a huge profit. you would hope that anyone who's given financial education could manage to make money out of it if that's what they want to do. But they do exist. Yeah, most of them are, but they do exist. They must have paying customers. But I'm not aware of any public authority that's providing information and charging for it. Maybe it is a test.
In the United States, there are two organizations. One's the American Association of Individual Investors, and you pay a membership fee. Another one is Better Investing, and that's more where people invest together in clubs, investment clubs. Again, a membership fee-driven model, but NGO, not a government regulator.
And we were thinking, and I saw something very interesting on the Ms. Schock presentation about the teachers in the stock market game, and somebody has evidence or research, but if you look at the youth who's starting with their financial planning, and you look at the parents, is there any influence of a parent who buys at the birth of the child a ETF for 18 years, getting a tax gain or tax reduction after 18 years, so not in the first year, but after 18 years? It helps you two things. First, paying for the education at 18 when they go to college. And second, if you have this long-term view and you're allowed to put in €1,000 each year for the child, but you also have to figure out which kind of way it goes and if you need to stabilize everything, is that helping the parent too? Because the child of just a born child, a newborn child doesn't understand, but as parents, they have to make that decision. Is there evidence? Is it a good idea? Is it a bad idea? Maybe from the panelists?
We have what's called 529 plans in the United States, which allows just that. There's a tax break for the parents to put money away for their child's education. There are certain dollar limits and thresholds, on an annual basis, and anyone can contribute to that. So it's not just the parents; it could be family, friends, grandparents, exactly. And having that time value of money, 18 years or so before going to university is yes, it's helpful. What we've seen, though, in the United States, it's generally those who are more well-off are the ones who take advantage of the plans because they have the resources and they have the knowledge of the program. There has been a think tank that if you use if you invested $2,000 on the day a child was born and had just average returns, and I'm not talking for college education, but for retirement planning purposes, that $2,000 if left alone for, say, 65 years to when they would retire, they'd have over $1 million. So, yes, that time value of money is very important, and especially for college planning. And we do have that scheme in the United States. It's just it's not as widely used as we'd hoped it would be. It's still fairly young.
And the next question, of course, that crossed my mind because I'm very cynical to the industry. There are coming kids at age of 18 with $25,000, $50,000 or euros on the market. And how are they marketing? Because every bank wants this kid with 18 years going to college.
Stephen seemed to have that same problem himself this morning when he was 25, that he had, €25,000. I'm not aware of that many teenagers in the United States having that kind of money.
No, but I'm talking just in the in the most perfect world that everybody did that for the child and it adds up. Because if we talk about financial literacy and we try to do it with the parents, how do we get to measure the kid when he's 18 and his money's falling off?
That doesn't, just in the United States, we have problems with student loans. So the kids are just getting into debt at age 18. They don't have $25,000. In fact, they're more likely to have negative $25,000 in student loans at that point in time. So if someone else might have a different experience.
Some research that suggests around a third of 18 to 24-year-olds are over indebted, and that includes a subjective measure as well as an objective one. But we do know it's a real problem that kids turn 18 and suddenly they have this whole world of credit opening up to them. We've done quite a lot of research around young people's regrets in terms of money mistakes that they've made. Had some amazing stories about people, I don't know if you know what Wonga is, I don't know if you have, but payday loan company, people using payday loan companies to get pizza, and something called credit card roulette, which is where you put all your credit cards on a table, pick one out, and whoever's get picked out buys drinks for the rest of the evening. So I think there is a real issue with young people turning 18, suddenly having this whole world open to them, and not necessarily having the skills or the right attitudes to be able to deal with that. And that's why we're very much advocating as part of the strategy a lot of experiential learning at a younger age, allowing kids more responsibility for paying for and budgeting for the things that they need to have, the essentials, allowing them to make smaller mistakes so that hopefully when they turn 18 they'll have the knowledge and the experience behind them not to make those big mistakes and blow their $25,000 on whatever it is.
Maybe one question to the national regulators, more than maybe Adele. I mean, the surveys and evaluation that you use to measure financial education initiatives, are you aware of them being used as well for other policy making in the area of investor protection? Or are policymakers sometimes approaching you for your insights from that work? And is it useful to them, do you feel?
So I'm sure there are more examples, but one springs to mind. So we're currently going through a big programme of welfare benefits reform in the UK. One of those things is a move from benefits being paid weekly to monthly, and there's a lot of concern that that's going to cause a lot of people problems, because some of them have been used to, for years, budgeting very well and managing a really small income, and making it last, but on a weekly basis. And actually that transition to monthly budgeting could be a huge leap for some people. So they have been coming to us and using our insights from the data about, the proportion of people budgeting now, who's doing it, how they're doing it, to try and develop their programme for really supporting people who are going through that transition. So that's one example. I'm sure there are a lot more, but yes, yeah.
I give an example because the FSMA is the control authority and has now developed a risk label for products. And what was very interesting is they operate as a regulator, but they came to the financial education department, the people doing the regulations came to see us, and we developed together a risk label which is easily understandable for the consumer, and which is now introduced by law and will start in 2015. So what we have is actors on the field come and see us. This we already have. Other regulators, other institutions didn't yet, on a policy basis, didn't yet come and see us, but internally there is already, after 2 years, they came to see us, which is work in progress. We only exist 2 years, so I think it's... And I think it was very interesting for us, but also for the rest of the organization, to introduce customer analysis, customer data, customer studies in the decision making. It's a new way of thinking how control is being organized.
And I'll address it from a little bit different perspective. My office has also been involved with investor testing, and that is around rulemaking that the Commission puts out, and especially as it impacts retail investors. So we don't focus group test every rule, but for those that have impact, especially, like I said, with retail, my office may be involved to do that. And recently, we're testing target date funds. These are essentially mutual funds that say we plan to retire in 2040. So you're working, and then as you get closer to retirement, they adjust. Well, we found that in the market decline in the recession of 2008, that there were target date funds that had the name 2040 that had radically different underlying investment products. Some lost 43%, some lost only 10%. And we were trying to figure out why the difference in that. And it was because of how those funds were invested. So we did some investor testing around that, which was certainly instructive to the Commission for rulemaking, to looking at how to manage advertising, how to make sure that the funds, the use of the numerical date of retirement, because it was sort of these products then were being used to sort of set it and forget it, if you will, that you didn't have to readjust them. And because of a law change of the Pension Protection Act of 2006, these were now qualified investments in our 401k plans. So a lot of money was going into these new products, but we were just concerned about the underlying difference with it. And so that was instructive. But one part that came out of the research that was totally unexpected was that investors thought there was a guaranteed component to target date funds. There's no guarantee at all. You know, you're at market risk. And we, as a regulator, never expected that as an outcome. We were quite shocked that so many, it was over 25% of investors, and these were folks who invested in target date funds, thought there was a guarantee component. So that certainly was instructive and useful. It's a little bit different than investor ed evaluation, but it was part of our investor testing.
Any more questions from the audience to our panel? It's getting late. I have one last question, if I may. Adele, you said that before, that basically there shouldn't be a separation between program budget and evaluation budget. But I mean, we all know we have to think, we always think in buckets and have to put our money in jars. And so if you had to decide by force what part of your money goes into delivering and what part goes into measuring, what would be a good way of deciding that? Or
a lot of it depends on what you're going to do next. So if you're running a program that's trying to address a very specific short-term problem, like in the UK, they had a problem when a company went bust and people had been buying vouchers for Christmas. So if you're addressing something like that, you probably don't need to put any money into evaluation because you've got no intention of ever doing it again. You hope it's going to work, but even if it doesn't work, there's no loss. Whereas if you're piloting something and the intention is it's then going to become an enormous national program, then why not put 50% of your budget in? Why not put 90% of your budget into evaluation? Because at the end of the day, that's still going to be a tiny cost compared to the potential disaster of then running it at a national level and losing everything. So there is no one size fits all. We use this phrase so much, but it is really important to think about what it is you're going to do with the information you get from your evaluation and what it is you intend to learn from the program that you're looking at.
Smart investment fraud campaign, that was the goal, was to use it initially to pilot test the program, to grow it, and then my guess is at some point in time it'll be reevaluated. Now, and I'm not the researcher, you are, as far as how often do you reevaluate a program? If it's an ongoing program, that 90 to 10, over time really does become quite de minimis. Challenge for us is we have our appropriations on an annual basis. So money I got in 2009 doesn't mean that's going to be the same money I get necessarily in 2010, 11, 12, 15, 17 going forward. So I think that can be a bit of a challenge, especially if you don't have other external funding sources.
Absolutely agree with Adele. It depends what program you're talking about, what the context is, how you're going to use the evaluation findings. But I would say that if something has been proven to work in a particular context and you're rolling it out, you don't need to keep going with that level of evaluation. If you know something works, just monitor it, quality assure it. So I think it's all about using resources strategically, both in terms of resources for actual delivery, but resources for evaluation as well. I often hear this 10% rule get bandied about. 10% I think someone just plucked it out of the air one day and thought it sounded reasonable, but I think it's a huge range and it really depends on a number of variables. So I'm afraid I have no hard and fast answer to that.
Well, we blocked 5% of the budget in research, but I must admit I didn't use it fully the first years. We'll use it definitely now, but I have done a lot of satisfaction studies before coming to the FSMA, and what we try to do is to build our sample and having parts of the sample that we check on a yearly basis, but the different parts of the sample contribute to the bigger measurement, and the bigger measurement only comes out every 3 years, and because it's also a longer trend, but we measure in the meantime with smaller samples on a more continuous basis, and this makes research, the expenses for research lower, because I agree too that you need a certain impact of your action, so you need also the money to put it in the activities. But I agree fully that it's only by measuring that you know what works. So we definitely do measurements, but it's a trade-off. Yep.
Okay, I think then we conclude the panel here. Thank you so much.
Thank you. Concluding remarks.